Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. You know, the more things change, the more they stay the same. I keep coming back to this notion as I process the results of the presidential election. Now, last week I was on vacation, and I hope you had a chance to listen to the Ask Mike Anything segment. I thought it was pretty fun, pretty good. So if you haven't, check it out. But since I recorded the last real show actually on election day before the results were in, I really haven't had a chance to talk much about the election and the impacts of it as I see things moving forward. So today I want to put things in a little bit of a broader perspective. It's really been interesting watching the stock market and gold markets and really all of the financial markets as they've responded to the election of Donald Trump. We've seen stocks going up. We've seen a very strong dollar. And I think a lot of that has to do with the anticipation of some of Trump's trade policies. We've seen a big sell-off in the bond market. We're seeing Treasury yields increase. And we also saw a big sell-off in gold and silver, some pretty significant down days over the last couple of weeks. Now, not really surprising. I mean, we knew that the safe haven trade would unwind once the election results were in. The fact that it was not a disputed election, I think really sped things up. I think there was some anticipation of electoral uncertainty. Could that lead to, civil strife? And since we got through the election and so far things seem to be proceeding smoothly, I think a lot of that safe haven trade unwound. And let's be honest, it's typical for gold and silver to sell off with Republicans taking control of the federal government. And historically, gold has not fared as well during Republican administrations. Now, of course, there's all kinds of things that can change those historical norms. If we have a big economic meltdown under Trump's watch, and I think that's highly possible, not because of anything Trump does or doesn't do, but because we still have to pay the piper for the monetary malfeasance during the COVID years. If that happens, all bets are off. But so I think that's kind of broadly why you're seeing what you're seeing in the gold and silver markets. Now, over the last couple of days, we've seen some rallying and gold and silver gaining back some of those losses. I think, as always happens in the aftermath of any event, you get some amount of, they kind of overdo it, right? Overreaction. It's like in football, they talk about overreaction Monday, right? You look at the games that happened on Sunday and you freak out based on whether your team won or lost. And sometimes that freak out isn't quite as warranted. And I think we see that in the markets quite often. I also think that we've seen some people come to the realization that inflation isn't going anywhere. And I think that's a big reason why we're seeing bond yields rise, especially on the long end of the bond market, on those 10-year, those 30-year bonds. People are looking ahead and they're realizing that, inflation isn't really going away, right? We got the CPI report last week, and I didn't even end up writing about it, again, partly because I was on vacation, but I thought it was interesting that once again, we had a big print, a 0.3% month-on-month increase in core inflation. And of course, core inflation strips out the more volatile food and energy prices. And we keep seeing this 0.2%, 0.3%. Doesn't sound like a lot, but when you annualize 0.3% over a year, that's 3.6% core inflation, and that's way above the Fed's 2% target. Every one of the CPI reports that we've seen over the last 3 or 4 months have not been as good as you might be led to believe if you're just listening to the headlines on mainstream media. There are a lot of things in these inflation reports that seem to indicate that inflation is alive and well. And as we're going to discuss it here in a minute, it's alive and well for other reasons beyond just what we're seeing in the CPI. So, I think a lot of people in the mainstream, they've seen the election of Trump. I think there's some anticipation that there might be tax cuts, there might be some economic stimulus that happens because of that, which could fuel inflation. Now, again, I think this is a misunderstanding of inflation. Economic activity does not cause inflation. Money printing causes inflation. Economic activity is good, but that's the kind of Keynesian mainstream perception that, we're going to have a hot economy, so inflation's not going to go down and the Fed's going to have to keep interest rates higher for longer. And of course, that's bad news on the other side of the equation. We still haven't dealt with the fallout from the rate hikes. And as I've talked about before on the show, it's not so much that the Fed broke things by hiking rates. They broke things by keeping interest rates artificially low for the most part of 20 years. These 0% interest rates that we saw through the entirety of, the 10 years after the 2008 financial crisis. That's what broke things. That's what was unnatural. The interest rate level that we're at now is still historically low, and yet everybody's worried because this debt-riddled bubble economy can't function in even a modestly high interest rate environment. So, I keep saying the crash is coming. There's nothing that Trump can do about it. I'm afraid it's going to happen on his watch. It's just a matter of time because the monetary malfeasance has broken things over a long period of time. And, it gave us a boom. We've had some nice booms, especially if you're, in the stock market. But the bust is always commensurate with the boom. So that's bad news. Now, before I delve into some more deeper analysis of the post-Biden economy, the Trump economy as it may be, I want to go back and clarify a little bit of what I said on the show that I recorded on Election Day. I made some people angry with that show. I got the emails, I got a couple of messages. And if you didn't listen to that show, I basically downplayed the impact of the election. I said there are things that aren't going to matter no matter who wins the election. And I think this is particularly true of the trajectory of the economy. And I think that made people mad because they thought that I was just hammering on Trump, that I was being negative, that I was anti-Trump. And that's not really the case. To be fair, this is just kind of what you're going to get from me because of my broader political philosophy. So I thought I would just kind of share that real quickly with you so you have some context about where I'm coming from. I think I've mentioned this before, but decentralization is at the core of my practical politics. I want less power in Washington, D.C. I want more power in state and local governments. And as such, I'm a staunch constitutionalist. I've been accused of being a constitutional fetishist, that I'm too dogmatic about the Constitution. I don't think you can be too dogmatic about a Constitution when you understand what the point of a Constitution is. Why did the founding generation want a written Constitution? Because they wanted the limits on government power to be explicit. That's what the Constitution was supposed to do. It delegated specific powers to the federal government and left everything else to the states and local governments. James Madison summed it up in Federalist Number 45 when he said the powers delegated by the proposed Constitution to the federal government are few and defined. Those which remain with the states and the people themselves are numerous and indefinite. That's the system we're supposed to have. The federal government isn't supposed to be doing a lot of what it does. Right? So no matter who the president is, and no matter what policies he might be advancing, if they aren't federal powers authorized by the Constitution, I'm going to have a problem with it. And if we go back through virtually all of the presidents, none of them have been particularly friendly to the limits on federal power. When people are out of power, they talk about, yes, power should be limited. They should be limited for that guy, but not for our guy, because our guy's he's going to do good stuff with the power. And it's just not okay for a president to exercise unconstitutional powers, even if he's doing things I like, even if he is advancing policies that I think are good. John Dickinson is often referred to as the penman of the revolution. He was extremely influential in the years leading up to the revolution. And a lot of his writing really encapsulates and formalized the principles of government that were brought into our constitutional system. And Dickinson warned what would happen if we allow the precedent that government officials can cross constitutional lines. He wrote, "All artful rulers who strive to extend their power beyond its limits endeavor to give their attempts as much semblance of legality as possible. Those who succeed them may venture to go a little further." In other words, when you set that precedent, the next guy is going to take that power and then push the limits even further out. Dickinson went on and he wrote, "For each new encroachment will be strengthened by the former. That which is now supported by examples, growing old, will become an example itself and thus support fresh usurpations." So in other words, when you let your guy cross those constitutional boundaries, you're in effect giving permission for the next guy, who may not be so good, to do the same. So you see, it's the power itself that's the problem. It's not just the people who are using the power. And here's the thing. When you allow your guy to do things that stretch the limits of federal authority, the next person to hold power will be able to justify whatever they do. I mean, after all, the other guy did it, right? We heard this when Obama was in office. You know, Bush did it, so Obama can do it. And it continues ad nauseum. That's why every single administration seems to expand federal power. And it just sends us spiraling down this drain of ever-increasing federal government. This is how we ended up with the biggest government in history. So I think on my election day show, some folks misunderstood and thought I was just being anti-Trump or just being a negative ninny. That's not it at all. I mean, I'll come right out and say it. I prefer Trump over Harris. I think he will be better than she would have been, you know, however you define better, for at least for my political views. But I think he might even drive some positive change. But I also think it's important to hold Trump's feet to the fire. In fact, I think we should be, you know, if you're a conservative or a libertarian, you should be more adamant about holding Trump to the fire than you were Biden. If he strays from conservative or constitutional principles, call him out. Don't make excuses for him. He will be a better leader if he knows the people will hold him accountable, right? And it's not just about personalities. It's about the Constitution and the system. We have to preserve the system itself. And I'm afraid that it's already been wrecked, but we don't want to wreck it more. We want to try to push the needle back towards constitutional government, back toward limited government, back toward a system where, you know, presidents aren't just doing whatever they want. So that's really where I'm coming from, okay? I'm not a partisan. I don't get into partisan politics. I'm about the Constitution. I've mentioned before, I'm the communications director at the 10th Amendment Center, and our motto is follow the Constitution every time, every issue, no exceptions, no excuses. And that's true no matter who's in power. So with that framework in mind, I want to reiterate some of the things I said a couple of weeks ago, but now in the context of knowing that Trump is going to be the next president. And really, the thrust of what I was trying to get at a couple of weeks ago was that there are things that aren't in the president's control that you can't expect him to fix or make better. And one of the biggest things is he's not going to fix inflation. Now, inflation has arguably been the biggest economic issue facing Americans. I think that it's a big part of what drove the Trump victory. You know, they always say it ultimately comes down to the pocketbook, and people are bent under the pressure of ever rising prices. You know, I saw the other day that if you look at the devaluation of the dollar since the COVID era, it is down. The purchasing power of your dollar is down over 20%. So that means really we're not looking at 3.5% inflation or 9% inflation. It's closer to 20% price inflation. So, no wonder people wanted a change. But here's the thing. We give presidents far too much credit for good economic outcomes and far too much blame for the bad ones. Biden didn't make the stock market go up, and quite frankly, Biden didn't have a whole lot to do with inflation, and Trump isn't going to make inflation go down. And I think the reason people have trouble wrapping their heads around this is the fact that most people just don't understand inflation. Do you know what makes inflation? Money printing. Period. Milton Friedman hit the nail on the head. Inflation is always and everywhere a monetary phenomenon. So, in a nutshell, inflation, when you just say inflation, it used to mean an increase in the supply of money and credit. Now, a symptom of this monetary inflation is price inflation. And it's what we saw after the rampant money creation that happened during the COVID era. Now, who controls money creation? Essentially, it's the Federal Reserve. Not the president, not Congress. The Federal Reserve is running monetary policy. And it isn't doing anything to fix inflation. In fact, the Fed has surrendered to inflation. Even as I speak, there is more inflation in the pipeline, and there isn't a dang thing that Donald Trump can do about it. Now, with that in mind, I want to talk a little bit about the Fed meeting a couple of weeks ago, because I think that really helps set the context of why I think inflation is going to continue to be a problem, regardless of Trump's ascendancy to the Oval Office. I can sum up the last Fed meeting with two words: unsurprising and bland. As anticipated, the Fed did cut interest rates by another quarter point. So we now have the current interest rate in the range between 4.5 and 4.75%. This is high for recent times. I mean, after all, for a decade after the 2008 financial crisis, it was zero. So 4.5 is a lot bigger than zero. But as I mentioned before, this isn't high in terms of the historical norm. This is actually slightly below the historical average for interest rates, but that's where we are. The messaging coming out of the FOMC meeting wasn't really much more remarkable than what they did. Federal Reserve Chairman Jerome Powell kind of walked this tightrope. He was very careful not to send any strong figures or any strong signals about the trajectory of monetary policy. The FOMC statement noted that, quote, economic activity has continued to expand at a solid pace, but it noted that the labor market conditions have generally eased. And as far as the inflation goes, the FOMC said, quote, it has made progress toward the committee's 2% objective, but inflation remains somewhat elevated. And a word that you heard over and over again in this Fed meeting was data, right? We're data dependent. The FOMC statement said, in considering additional adjustments to the target range for federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risk. Powell reiterated this data dependence in his post-meeting press conference, emphasizing that the central bank is not on any, quote, preset course. And he asserted, we will continue to make our decisions meeting by meeting. Powell went on to paint a picture of a Fed poised to pivot toward any direction necessary. Quote, if the economy remains strong and inflation is not sustainably moving toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can move more quickly. Side note, kind of weird to me that we could have inflation fall too quickly, right? I mean, inflation in the terms that Powell is talking here, he means prices, right? So we don't want prices to fall too quickly. I don't know about y'all, but I could use some prices falling really quickly. But that's the mentality. I've said this over and over again. Inflation is an intentional policy. It's not something the government doesn't want. It's something the government doesn't want you to notice. Always keep that in mind. But anyway, if you kind of parse out everything that Powell said, basically he's just saying going forward that no matter what the Fed does, he can say, well, I told you that's what we were going to do, right? He's kept every option open. Now, while giving no hint at a timeline, Powell did indicate that the general trajectory of interest rates is going to be lower, which is what everybody wants to hear. He said the lower borrowing costs are necessary for the Fed to achieve its dual mandate of price stability and maximum employment. In other words, these people know darn good and well that higher interest rates are going to collapse the debt bubble. And that would be bad news and would create a massive economic meltdown. And they're trying to avoid that. They're trying to walk the tightrope, even as much as Powell's walking one with this messaging. Again, it's revealing, right? It shows that the central bankers still worry that this higher interest rate environment is going to crack the bubble economy. And they're right. And I've said it, and I will keep saying it. This economy can't function in this rate environment because it's loaded up with debt, right? The fact that the U.S. spent over $1 trillion in interest expense on the national debt in fiscal 2024 really reveals the extent of this problem. And again, I have to reiterate this. This isn't something the president can really control, right? He can't dictate monetary policy. I mean, he can scold Powell, but I don't think Powell cares. And the truth is, if we're going to be honest, Trump's instinct is for easy money. I mean, if you remember back during his first term, before COVID, Powell was trying to raise interest rates and normalize monetary policy, finally, after the decade of post-2008 financial crisis easy money. And Trump kept calling out Powell and saying he needs to cut rates. He needs to quit raising rates. I mean, he was all over Powell in the media and on Twitter, trying to get him to cut rates even as he was raising them. I mean, think about it. Trump is a real estate developer, right? He loves easy money. He loves low interest rates. He knows that it juices production, but it also juices debt. And, as somebody who has had his share of bankruptcies, he probably needs to consider that too. But, yes, easy money juices the economy, but it always comes at a cost. Inflation, right? There's always a dark side. When government intervenes, even if it seems good at the time, there's always going to be unforeseen consequences. As our good friend Bastiat pointed out, a good economist considers both the seen aspects of a policy as well as the unseen. And I've said this before, unfortunately, we don't have a lot of good economists out there. So, bottom line, we have a Federal Reserve that is on an easing trajectory. And as I said, that means we have a Fed that's increasing inflation. Remember, the definition of inflation, monetary inflation, is an increase in the money supply and an increase in the availability of credit, which further expands the money supply. That's what we have right now. The money supply has been increasing since this summer. We are back on an inflationary trajectory, even though we still have core price inflation running well above the 2% target. Now, interestingly, Powell actually insisted that monetary policy is still restrictive, even with the most recent rate cut. Now, the Chicago Fed's National Financial Conditions Index undercuts Powell's claim. As of November 1st, the NFCI, that's the National Financial Conditions Index, it came in at a negative 0.52. And that negative number indicates a historically loose financial conditions, or that we have historically loose financial conditions. When we start seeing a positive number, that means financial conditions are tight. We haven't seen a positive number in months. I mean, we've had, even at the height of the rate hikes, we were still running a historically loose monetary policy. That's why I keep saying the Fed has not done enough to slay price inflation, to really get at the root of inflation. Go back to Paul Volcker. He tamed inflation in the 1980s, coming out of the 70s, by raising interest rates to 20%. We got to 5%, not enough. It never did do enough to truly rein in inflation. Now, you might be thinking, well, Mike, Trump could get rid of Powell and just put somebody more friendly in the Fed chair. But during his post-FOMC press conference, Powell insisted he would not resign if Trump asked him to, and he pointed out that the president can't fire him because, quote, it's not permitted under the law. And he's right. So the bottom line is Trump is kind of stuck with Powell until Powell's term is up. Speaking of Powell and Trump, Powell insisted that the election of Donald Trump would have, quote, no effect on our policy decisions, which I kind of doubt that. But the Fed's always going to say that, right? They have to maintain this stance of neutrality. He did concede, though, that new policies coming out of the next administration could have an impact on future monetary policy decisions insofar as they change the economic situation. Quote, just in principle, it's possible that any administration's policies put in place by Congress could have economic effects over time. So along with the countless other factors, forecasts of these economic effects would be included in our models of the economy and would be taken into account. This kind of hints at something that kind of irks me. And it's this idea that monetary policy can be micromanaged by these pointy-headed PhDs, just because they have these economic degrees that they can use these models and figure out the perfect monetary policy. They can't do it. They don't have the knowledge to do it. They can't see all of the economic consequences of any individual decision. No human mind or group of minds can effectively do that. Interest rates should be regulated by the markets. Interest rates are just prices, right? It's the price of money. That should be left to the market to determine, to set those interest rates based on market participation in what the market needs. You don't want the federal government regulating the prices of anything else because it causes problems, right? You end up with shortages or overproduction. I jumped all over Harris for the idea that she was going to stop price gouging by basically regulating the price of groceries. And I explained in a show several weeks ago that this would create all kinds of problems. Price controls always do. Monetary policy is nothing but a price control on money. So we should not expect any better results. These academics simply cannot regulate the market for money. And we end up with exactly what we've seen over the years, booms and busts and malinvestments and debt and all of these things that are the direct results of these monetary decisions. So, anyway, basically Powell gave no hint as to what a Trump presidency might mean for the trajectory of interest rates. He gave no indication of anything at all at this Fed meeting. My impression of the Fed's trajectory, it hasn't changed much since it surprised us with the supersized rate cut in September. I still believe that the Fed has surrendered to inflation. They're kind of wanting to temper that, kind of leave the possibility out there that they may not cut rates as fast, but they're on the rate cutting mode because, again, they know that they have to rescue the economy, and I still think it's too late for them to rescue the economy. So, bottom line, Trump is going to have to contend with rising prices. He's going to have to contend with inflation. It's not in his power to do much about it. And unfortunately, I don't think most people understand inflation well enough not to pin it on the president. I mean, after all, Republicans just spent 4 years blaming Biden for price inflation. And the blame goes back to all of the money that was printed and handed out, like dumped out of a helicopter during the COVID era. Biden did a lot of really horrible things while he was in office, but, he really wasn't the cause of the widespread inflation that we've experienced. And Trump's not going to be the cause of the widespread inflation we're going to continue to experience in the next 4 years. Now, there is one thing that the federal government can do to tame inflation, and that is to cut the borrowing and the spending and to reduce the debt. But with all due respect to President Trump, I don't think he can do that either. I mean, I love the commitment to reducing the size of government. I love Elon Musk getting in there and chopping government agencies and chopping government workers. But I don't think people realize just how much debt there is and how much the federal government overspends month after month. The Biden administration blew through $584.22 billion last month. That was a 24% year-over-year increase in spending. Outlays for Social Security, Medicare, and national defense all had significant increases. And incidentally, those biggest outlays are all things I know Republicans won't touch. They're not going to cut Social Security, they're not going to cut Medicare, Medicaid, and they're not going to cut national defense, simply because there's too much political fallout. Now, here's the problem. The portion of the U.S. budget that's available for just wholesale cuts is what we call discretionary spending. It represents just a very small part of the overall government spending. In fact, it's only 27% of the total federal budget. Discretionary spending, 27%. The other 60+% are entitlements that they're not going to touch. So even if Trump and his team can take a huge axe to spending, there's only so much on the tree. And keep in mind, there's only so much that the president can do. I mean, even if he is really committed to cutting spending, he needs Congress to really make the deep cuts. And I'm afraid there are enough establishment rhinos still in Congress who are going to thwart any attempt to really slash spending. And I hate to be cynical, but I'm cynical. I've seen it year after year, decade after decade. Spending just increases. That's what the federal government does. They may have this budget and they'll say, oh, we're going to cut spending, we're cutting here, we're cutting there, and then they just find new ways to spend. There's always a disaster or a war or some foreign country that needs help. They always find new ways to spend money. Spending goes up year after year. The national debt goes up year after year. Every president since Calvin Coolidge has left office with the U.S. in bigger, deeper debt than it was when they took office. So that's just the way it goes. That's just the reality of politics. I'm not slamming on Trump. It's just the reality. Government spends. It's politics. Politics is about getting votes. You get votes by giving people stuff, and to give people stuff, you got to spend money. So, Trump may be able to slow down the increase in spending, but I would be willing to bet that year over year spending won't go down during a Trump administration. It might go up slower than it would have. They might even call that a cut, but it's not really a cut. They do that in Washington, D.C. If the budget was supposed to go up 10% and it only goes up 5%, they'll call that a 5% spending cut. Well, no, it's not really a cut. Spending went up 5%, but they'll say that's a cut. And again, that's better than nothing, but it's not going to fix the fundamental problem. And again, I have history on my side here. Trump left office with the second largest increase in debt for any administration in history. That's just the reality. That's just the numbers. Only Obama increased the debt more in dollar terms. Now, granted, Trump had the COVID lockdowns to contend with. He had an entire shutdown of the government at the end of his term, or the economy at the end of his term. But even before that, we were staring down the barrel of trillion-dollar deficits, just like Obama gave us. So, Trump doesn't have a good track record when it comes to deficits. Now, hopefully he learned his lesson in the first term. He's definitely talking a better game about cutting government. And I hope he really commits to slashing spending. But I got to be honest, I'm kind of a show me, don't tell me kind of guy, right? Money Metals director Clint Seigner really summed up in an article that we recently published headlined, "Inflation Isn't Likely to Go Away." And this is what he wrote. "There may be reason for hope of fiscal reform, but investors will want to temper that emotion with reality. There is a lot of difficult work to be done, and it won't be completed without plenty of institutional resistance." So even if you believe that Trump is the guy, he's just one guy in a big system, in a big swamp, and, getting things done is easier talked about than actually doing. So please understand that my negativity and my caution and my general bearishness on the trajectory of the economy isn't about Trump per se. I'm not a libtard, as a few people have asserted. I'm a free market guy. In fact, I'm probably more free market than most quote-unquote conservatives out there. The thing is, I recognize the structural issues in the economy that are beyond the control of the people in power, no matter who those people are. We have too much debt. We have too much monetary malfeasance. We have too many malinvestments in the economy. This is the result of decades of bad fiscal and monetary policy. And I can sit here and point fingers and blame all over the place, but the bottom line is, until the government as a whole, not just a few people in it, finds the political fortitude to deal with these problems, they're just going to keep growing until eventually the whole thing unravels. And I'm afraid that that's ultimately where we're heading. I just don't feel like that anybody really has the political will to inflict the pain that it would take to fix the problems that we have now. So that's my spiel, and I stick with it. Before I sign off, I want to give you a quick update on the silver market. We just got a report from the Silver Institute, kind of their middle of the year projections, and they say industrial demand is on track for another new record high this year, and that the silver market is on pace for its fourth consecutive annual supply deficit. So in other words, the amount of silver used this year is going to outstrip the amount of silver that is dug out of the ground or recycled. So that means that reserve stocks are going to have to be drawn down to meet this demand. According to the latest projections by Metal Focus, who puts together the analysis for the Silver Institute, record industrial offtake, along with the rebound in silver jewelry and silverware markets, will drive total demand to, get this, 1.21 billion ounces of silver. Man, that's a lot of silver. That's going to be a 1% year-over-year increase if that's how it comes to pass. Industrial demand is actually expected to rise by another 7% this year and surpass 700 million ounces for the first time. So I'm going to say that this little post-election dip in the silver price and also the gold price presents a buying opportunity. And again, that's for both gold and silver. If you believe that gold is an inflation hedge, and it is, I'll try to remember to link to an article in the show notes page that showed just how well gold has performed in inflation-adjusted terms. But if you believe that, and you look at the trajectory of the economy and you recognize that inflation isn't going anywhere, then you probably don't want to be selling your gold and silver. You probably want to stock up on some. After all, the monetary debasement is going to continue, whether, maybe slower than it was under Biden, but it's going to continue. So you want to have real money. So now is a great time to call Money Metals at 800-800-1865. Talk to a Money Metals precious metals specialist and let them tell you how gold and silver can fit into your investment portfolio, what products might work for you. These guys are fantastic, guys and gals, and I just highly recommend talking to them. And now, I know a lot of people don't like to talk on the phone. You can go to moneymetals.com and chat with a precious metals specialist right online. Or if you don't want to talk to anybody, you just want to buy some gold and silver, just go to moneymetals.com, search for what you're looking for, and you can buy right online. So that is going to be a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything that I've talked about on the show today and a lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox every single day, make sure you sign up, get on our email list. Now, of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, you'll also be able to tune into our Market Wrap podcast every Friday, where you'll get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold and silver, economics, and investing. This past week, I talked with Jeffrey Tucker over at the Brownstone Institute. We talked about kind of the trajectory of the economy under a Trump presidency, and also about some of the after effects of the COVID era. So check that out. And as always, I really appreciate the fact that you listen to the show, that you take time out of your day. I know there's a lot of things vying for your attention, so thank you for spending a little bit of time with me. Have a fantastic rest of your week, and I will be back behind this microphone again next week.